Okay. Hello, everybody. Welcome in. Please make sure that you choose the language that you would want to be in. We're going to go ahead and start. You haven't missed anything at all. And now everybody's starting to come in. So I know everybody's just closing up the centers or all the children are leaving. So we're going to give it some time. Okay. Okay, so we're going to welcome everybody and thank you for joining today's webinar on cash flow management for childcare businesses. I'm excited to share some practical insights that can help strengthen the financial foundation of your business. Your business's cash flow describes the amount of money coming into and leaving your business over a certain period of time. In addition to helping you meet your current financial obligations, understanding and managing your cash flow helps you plan for the future. It helps you to seize opportunities for growth, and it helps you to make some sound decisions, especially for your business, right? So, as childcare providers, you're already managing so many aspects of your business daily, from providing quality care to children to managing staff, maintaining your facilities, communicating with families. So today we're going to focus on the aspect of your business that might not always get enough attention, but is absolutely critical to your sustainability and success. Okay. So if you will allow me, I do need to read this short disclaimer. Okay. So the information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and the recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. All right, we got that out of the way. All right, so in today's conversation, we'll explore three main questions. First, what exactly is cash flow? Okay, and why is it so important to your childcare business? Second, what financial information do you need to effectively track and forecast your cash flow? And third, how do you actually get started in the process? Okay. So by the end of our time together, you'll have a clear understanding of how to develop and use cash flow forecast to strengthen your business's financial health. You'll also walk away with some practical tools and strategies that you can implement right away. I do have to tell you in advance that you got me on a topic that I love to talk about. So I'm super excited to be sharing this with you. So I'm going to see smiles and happy faces because we're talking about cash flow. Okay. So this is really important stuff. Okay. So, and I see some familiar faces that you're going to hear some of my same stories. Okay. So just bear with me. All right, so let's start by understanding what cash flow is and how it differs from your regular budget. Many of you likely already have a budget for your childcare business, which is great. It's excellent. But a budget gives you a plan for how you intend to allocate your resources. I've got this money coming in. Now, how am I going to use it? Every month you do this, but cash flow gives you something different, but just as important. So could just know, remember, okay, cash flow is different from your monthly budget. I'll tell you why. Once you have a monthly budget, you may still have questions like, how much am I making over time? Your budget might tell you what you expect to earn and spend in a given month, but your cash flow forecast will show you patterns over time, including seasonal fluctuations that are common in childcare businesses. Will you have enough cash to pay yourself? or to pay your bills. This is crucial because timing matters. You might have tuition payments coming in on the 5th of the month, but your rent is due on the 1st. Okay, so understanding cash flow helps you manage these timing differences. How much are you really making? This helps you see the actual financial health of your business beyond just a snapshot of a single month. What we sometimes forget is that cash flow even gives us a heads up on how we're going to do for the next month. Okay. So if you have these questions, learning about cash flow can help you answer them with confidence. The cash flow forecast is one of the best tools that you can have for understanding how healthy your organization is in the near term. Predicting cash flow is not about budgeting. It's about understanding how much money you're taking in minus how much money is going out, and crucially, when that money is moving. Okay. The challenge with cash flow is that you can have a lot of money that's owed to you, but if you don't have that money on hand to pay the bills, then your business can't find itself, then it can find itself in financial trouble. Okay, for example, you might have parents who pay you at the end of the month for care, but you need to pay your staff weekly. So this creates a timing gap that you need to manage. Okay, so knowing how much cash you have in the near term becomes a way of not only knowing what's coming in and going out, but it also gives you the heads up about upcoming challenges with having enough cash available. So this foresight is incredibly valuable for making the proactive decisions rather than being reactive, right? So you want to know what's coming up rather than making a decision that's too late. Okay, so here's where I like to make my analogy of the river flowing. I used this one earlier with some people. So imagine that you're on a beautiful river and you're floating in a canoe. Everything's going great. You're looking to the sides. Oh, it's so beautiful. Okay, consider this your cash flow. Going along, all is good. What you didn't realize when you started this river ride was that down the river are some rapids, big ones. Okay, and you're in this wooden canoe not suited for those rapids. Okay, so what I want you to do is consider those rapids to be a refrigerator breaking down or your home being flooded by a stopped up toilet for you family childcare providers, right? Were you prepared? Okay. Do you have the right boat to save you? Okay. The right amount of cash to save you from that major expense? Wouldn't you have liked to be prepared? If you had known, you would have brought a different boat, right? So, well, having cash in your cash reserve and knowing how much is in there is your metaphoric boat. Okay. Does that make sense for everybody? Like, okay, I need to know how I'm gonna get down the river, right? Okay. So this is why we need to know about our cash flow. Okay. So how do we get started, Melinda? How do we do this? Well, I'm glad you asked. I'm gonna tell you. Okay. So the following is a cash flow exercise, and it's going to guide you through the process of making an important cash flow prediction for your business over the next 6 months. We've purposely chosen the next 6 month time frame because it's a nice snapshot that allows you to make decisions a few months away, but it's not so long that many things could change. Okay. Okay, so once you get the hang of this exercise, you're likely going to want to do it on a weekly basis and make it one of your weekly habits. Some of the most successful childcare providers we know spend about 30 minutes each week reviewing and updating their cash flow projections. That helps them to stay ahead of the financial challenges. Okay. All right, so let's look at building cash flow in 5 steps, 5 easy steps. The first is gathering your documentation, picking a time frame and scenarios, listing income, listing expenses, and reviewing those trends. When we talk about income, we're talking about your revenue, the money that is coming in. Okay, and expenses are the money that's going out. Okay. Each step is straightforward and it builds on the previous one. Okay, step one, gather your documentation. You're going to want to pull about 2 to 4 months of documents because you want to kind of see a trend. You want to see, I always use the electric bill in his example. You want to see, okay, a couple of months ago it was, and this is like, I'm using maybe a home child care provider's uh, electric bill, right? Not a facility, right? But you might say that it's um, about $400 1 month, 375 the second month, and about 380 the third month. So you've got kind of an average, right? Okay, so that's why you want to have enough of examples so that you can make a good estimate. Okay, so you want to pull your bank statements. That's going to show deposits from parents, whether it's your subsidies, grants, as well as withdrawals for expenses. You want to pull credit card statements because those can capture many of your regular purchases for your business. If you use Venmo or other payment apps to receive tuition, be sure to include those as transaction records. And then utility bills help you to track consistent monthly expenses. And then any other records of ways that you receive or spend money should be included as well. Okay. Now you want to try to use the actual amounts when possible for greater accuracy, but if you don't have the actual amounts, it's okay. Just you can kind of use an average. Again, I'm going back to that example of an electric bill. Because you don't know exactly how much electricity you're going to use over the next few months. So you won't have that until you get the actual bill. But the more accurate you have, the more reliable your forecast is going to be. So I recommend creating a folder, either a physical or a digital folder where you collect these documents as they come in. Okay, making this process, it's gonna be a lot easier if you save some of these. Um, I could go on into a whole other page about or another topic about AI and how that has helped me to organize some of those documents. Whatever you got to do to put your stuff together to keep that all organized. Okay. All right. Step 2 is to pick a time frame and consider scenarios. Remember, this is not a budget, so try to choose a time frame that's long enough to allow you to make decisions past 1 or 2 months. But again, short enough in case there's a challenge or you need to make some changes that could happen down the road. We think about 6 months as a good time frame, but adjust as needed and choose what works for you. You don't want to go more than a year. And the reason for that is that as you do projections that far out, they tend to be less accurate, especially in a dynamic childcare environment where enrollments can change seasonally. Okay. You should also consider scenario planning, which can help your organization generally, but particularly in times of great uncertainty. So, when you're doing scenario planning, you can articulate changes that may happen over time so you can see and plan for their potential impacts. I used an example earlier. I managed a substitute program. And in that substitute program, as work was needed, I would send them out. But during certain times of the year, those day of schools that I would send the substitutes out to didn't need subs. But then during flu season, everybody was out, so they needed more subs. So I started to see that in this part of the year, I'm going to bring in more money. And at this part of the year, I'm going to not bring in more money. And so you start to notice those trends. And the reason you want to pay attention to those is because that's going to help you plan for the next one, okay, for the next year. Okay, so here's another example. What if 3 families leave your program unexpectedly? What if you receive that grant that you applied for? Okay. So scenario planning helps you prepare for these possibilities. When it comes to scenario planning, though you can use any number of scenarios, typically it's good to develop 3. Okay. First, you're going to do your best case scenario where revenue and expenses shift to ease the stress on your business. Maybe this includes full enrollment, timely payments from all the parents. Everybody's paying on time. You got all your children, and there's no unexpected expenses. The refrigerator's working just fine. Okay. So you have extra funding. You could have received a grant or you had a fundraiser. All of that is going to count as revenue. Okay. That's money coming in. Second, your best case scenario, usually this is status quo. If the future plays out as you currently expect it to happen, this is what is realistically this is what's going to happen. This is what you realistically predict will occur based on your current trends and information. The third is your worst case scenario, where revenue and expenses will trend in ways that could happen and would result in more difficult positions for your business. Perhaps this includes losing a couple of enrollments, delayed subsidy payments, or an unexpected repair cost. Man, the refrigerator broke. Oh no, right? Okay, so what are we going to do? All right, so creating these three scenarios helps you think through those possibilities and develop contingency plans. Okay, what am I going to do? What if, right? That's the point. So this practice can significantly reduce the stress when those changes occur because you've already thought um, through how you would respond. Okay. So this is why it's really important to think of those three. Best, your base case and then your worst case. To build the scenarios, identify the most significant factors and how they may trend in each scenario. Make sure you consider factors that are both the revenue and the expenses side. You want to look at both. Try to keep to just the most important factors, the 3 to 5 most likely to change in the future, which could have the most significant impact on your organization. So, for example, a potential increase in your healthcare costs by 50%. That would likely be a factor for your worst case scenario. Whereas a 1% increase in office supplies would likely not be included because it wouldn't significantly impact your overall financial picture. Make sure you include a list of factors. Write them down um, and put, when you do this, what that does is it ensures that you're going to remember how you got to this particular scenario that you created. So if you can articulate the cost impact in actual dollars, such as what happens if you get that $10,000 grant, okay, or a percentage, such as 10% increase to the cost of supplies. As you run through the rest of those steps, do one set of tables for each scenario so you can see the impacts. This might seem like extra work, but having those different projections ready will be invaluable if circumstances change suddenly. All right, let's talk about income and how to do this, okay? Income and expenses. Now that we've laid the groundwork with our documentation and scenarios, let's move on to the heart of cash flow forecasting. This is going to be tracking your income and expenses. This is where we're starting to put actual numbers in our forecast. Okay. Step 3 is to list your income. You'll want to categorize all the money that comes into your business each month. Okay. So it's really important. I'll probably mention this about a dozen other times. It's really important that you have a monthly budget so that you're practicing your monthly budget consistently. Okay. That way you see those trends. Okay. So for childcare businesses, common income categories include your subsidy payments, from government programs or agencies, grants that you receive from foundations, government programs, and other sources, tuition and fees paid directly by your families for care, and then always include another. There's always another. It was a bake sale that you had, or you won, you did a scratch off and you won $500 and you're going to put it towards your center, right? Wouldn't that be nice? Okay, so be specific about when you expect to receive each type of income. For example, if your subsidy payments typically arrive on the 15th of the month, note that in your forecast. If parent fees are due on the first, but typically come in throughout the first week, account for that timing as well. The more detailed and accurate you can be about your income timing, the better your cash flow forecast will reflect your actual situation. Okay, let's take a look at this example of how you might your list out your sources of income in a monthly budget, in the monthly format. So, for instance, if you have 10 children whose family pays 800 per month, your fees would be 8,000 monthly. If three of those children are subsidized, then you would receive 600 per month per child. So your subsidy income would be 1,800 monthly. Okay. And all you're going to do is just list that for each month. Now, um, honestly, it would be best if you did this vertically than horizontally, but for the presentation, we're doing it across the board. So basically it would total up at the end, see? But it would be best if you do that math. You know why, right? Because when we do math, take away and all that stuff, right? So 1,800, 8,000. We didn't get any grants this month, but we got $200 from that bake sale. And so our total for the month of January was $10,000. We're counting all the money that came in. This is not a profit. This is not how much money I made this month, okay? This is just how much money I brought in, okay? So that's really important to distinguish. Now, um, how is March? How is March? Okay, so we've accounted for both a fee increase, perhaps from 800 to 880 per child, okay? Because we're looking over here and we see that we have 800 extra dollars on in March, okay? And then we got an anticipated grant of $1,000, okay? So creating this detailed breakdown, that helps you visualize exactly how much money will be coming in throughout your forecast period. So from January, we had 10,000, we had 9,000 coming in February, and then we had 11,600 coming in for March. Okay. Remember that income is only realized when you actually receive the money. So not when it's promised or earned. I always have to remind myself of that. I have, I get paid on this day, and I did this little thing that this lady's going to pay me for, and a friend's going to pay me back for the money that I owe her, that she owes me. So I should have about this much. But then the friend didn't pay me back, and the lady canceled her order, whatever. So I don't have that money until it's in my hand. Okay. So, um, you have to consider that. If a parent typically pays late, account for the reality in your timing by placing the income in the month you expect to actually receive it, not when it's technically due. So if you have that when your parent does finally pay you, she was supposed to pay you in January, but she pays you in March, that money is not going to go into the January money. It's going to go into the March money. Okay? All right. All right, step 4 is to list your expenses. Similar to income, you'll want to categorize all the money that leaves your business each month. For childcare businesses, common expenses include um, staff personnel, which is typically your largest expense, because that's going to include wages, benefits, and any other contractor payments. Then you've got to consider taxes. Okay, that includes payroll taxes, property taxes, and income taxes. Then, of course, your rent or mortgage payments for your facility or home, your utilities such as electricity, water, gas, and internet, any vehicle expenses that you use, a car or van for your business, phone costs for business lines or cell phones, food and snacks for the children in your care. You also want to consider cleaning supplies, which have become even more significant of an expense recently because of COVID, right? Loan payments for any business debt you're carrying, bank fees for your business accounts or payment processes, and then again, always include another for those miscellaneous expenses that don't fit elsewhere. Okay. Be sure to know that with each expense, when each expense is typically paid. For instance, rent might be due on the 1st, while your utility bill might be due on the 15th. Again, this timing is so crucial for accurate cash flow forecasting. Now, here's an example of how you might list out your expenses by month. For many childcare businesses, personnel costs are the largest expense, often accounting for 60 to 80% of the total expenses. In this example, you can see personnel represents about 70% of monthly expenses. Notice that we've accounted for some typical fluctuations. Your higher utility costs in February, perhaps heating in the winter, a staff pay increase in March, and then a significant other expense in March that might represent an annual insurance premium or equipment purchase. Don't forget about these irregular experiences that don't occur every month, such as your annual insurance premiums, quarterly tax payments, or seasonal costs like higher heating bills in the winter or air conditioning in the summer. These irregular expenses can create cash flow challenges if you're not anticipating them properly. Also, remember to include a line for your own compensation if you're the owner. Too often, childcare business owners don't pay themselves or pay themselves last, okay, when cash is tight, okay? So by including your compensation in your cash flow forecast, you're recognizing its importance to the sustainability of your business. Okay, we're moving on to step 5. Step 5 is to review the trends in your cash flow forecast. Your total cash flow over the next 6 months will be the total amounts of revenue minus the total amount of expenses. Okay. You can also see cash flow for each month by subtracting your total expenses from your total revenue for each month. Look at cash flow month by month. That can be particularly helpful because some months your revenue might be less than the expenses, but in other months it might be more. This tells you when you need to save money from one month to another. Okay. For example, childcare programs experience lower enrollment during summer months or over winter holidays. That's going to create a seasonal dip in your revenue. By projecting that dip in advance, you can plan to set aside some extra cash during the higher revenue months to cover those leaner periods. Okay, the trend and analysis is where the real value of cash flow forecasting becomes apparent because it allows you to see potential cash crunches before they happen and take proactive steps to address them. Okay, so I'll go back to my substitute example. Since I knew they weren't going to be working during that month of winter break, the times that they worked more, I put some of that money aside so that we would kind of break even in the course of those months, okay, that they didn't work. So it would carry over. We had that understanding, okay? Or you might even see it in your forecast that you're going to have a really high amount in a certain period of time, and then as you go through those months, you see it average out until you get to that big influx again. Okay. All right. So here's an example of how you might calculate your monthly and total cash revenue or cash flow. Okay, and I do want to point out some terminology here. Remember that your total revenue is money coming in, expenses are money going out, okay? Um, these are the months, and then as you start to list it, I'm not I'll see if I can get on another slide. But those are considered to be your categories. So all of the things that you list, the money coming in, your bills, all of those are called categories. So a lot of times we don't know the terminology. It's really important to remember that. Okay. So for each month, you add up all your revenue categories to get your total revenue and all your expense categories to get your total expenses. Then you subtract your expenses from revenue to determine your cash flow for that month. Now, again, this demonstration goes from side to side. Total revenue, total expenses equals your total cash flow. But I put this little arrow here to show you that it's always better if you come down so you can see it kind of like a subtraction. Okay? Always like think of it in a math problem kind of way. If you look at the bottom row, that shows your totals over the entire 6 months. Okay, so this last row down here, excuse me, this last row down here is your total. Okay, um, a positive number is bringing in more than you're spending that month, while a negative number indicates that you'll need to draw on savings or other resources to cover your expenses. Um, The bottom row shows your totals over the entire 6 month period. This gives you a bigger picture view of your overall cash position. Even if some individual months show negative cash flow, as long as your total for the period is positive, you're generally in a good position. You just need to manage the timing of your cash carefully. Okay, so I recommend using a spreadsheet program like Excel or Google Sheets for this calculation, as it can automatically update your totals if you change any individual numbers, and that's going to make it easy to test different scenarios. But if you're using pen and paper, it's okay. You can still do that. Okay. 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 Now that you have your cash flow forecast in hand, the next step is to analyze what it's telling you. Okay. This analysis is going to help you to identify patterns, challenges, and opportunities for your business. So let's explore some key questions. Now that you have your cash flow projection, you should ask yourself a series of questions for each scenario to understand any trends that appear. First, are you profitable overall? This fundamental question tells you whether your business model is sustainable in the long run. Okay, are you making money or not? Okay. Second, are there months that are feast or famine? Okay, this helps you identify seasonal patterns that require special attention. Okay. Third and fourth, which months have the highest and lowest profit? If you understand these peaks and valleys, that's going to help you plan for when you'll have extra cash and will you need to be more conservative. Fifth and sixth, which categories are your highest and lowest expenses? This helps you identify where most of your money is going and where you might have opportunities to cut costs. This might be it telling us that we need to cut our Amazon cart. Okay, stop spending in Amazon. All right. And I try to be funny, sorry. And seventh and eighth, which categories are your highest and lowest revenue? This helps you to understand which aspects of your businesses are bringing money in. You want to go with the ones that are bringing money in, right? And which might need more attention or development. Okay. So by answering all of these questions for each of your scenarios, your best case, your base case, and your worst case, you'll gain a comprehensive understanding of your business's financial dynamics under those different conditions. Okay, based on your cash flow analysis, you might discover that you need to improve your cash position by increasing revenue, reducing your expenses, or adjusting the timing of your cash flows. So let's explore some practical strategies specifically tailored to childcare businesses that can help you improve your cash flow situation. If you completed your analysis and you find that you need to increase revenue to improve your cash flow, here are some strategies to consider. Obviously, the first one is to increase your enrollment. If you have room in your program, This can be the most cost-effective way to build your revenue. Start by asking your current families if they know of any other families in the need of care who then they could refer to you. Word of mouth referrals are often the most effective for child care programs. Also, reach out to your local child care resource and referral agency and other providers to find out if there's families that need care. Even adding just one or two children can significantly impact your revenue without substantially increasing your costs. Second, consider switching from a monthly to a weekly billing cycle. If you currently charge, this is a great one, hold on. If you currently charge 1,000 per month, most people assume that that works out to about 250 per week. But some months have 5 weeks, which translate to an additional $1,000 per year per child. So this method can be an effective way to increase cash on hand if you have families who constantly pay on time. So, however, if you have families who often miss payments, this approach can be challenging because it may mean more frequent follow-ups. But it can also mean more trips to the bank and more data entry on your end. So weigh the costs and benefits for your specific situation. And the reason that comes out, there's 52 weeks in a year. I don't know where that whole month goes, or 52 weeks in a year to 12 months. So if you're doing 12 months, you're getting that much less. Okay. Okay, another key strategy for improving cash flow is speeding up your billing and collections processes. So you should bill as soon as possible and don't let money owed to you wait. I know that we're caregivers and we have our heart, and mom says, "Oh, can I pay you tomorrow? Can I pay you next week?" And we're caregivers and we want to keep our kids and we love our kids. But you are also business owners, business managers. So you have to be a little bit firm and say, "I'm sorry, I need that money." Okay? It may be a difficult conversation with families, but the cash is critical to keeping your business and the service they rely upon alive. So consider childcare management systems that can help automate billing while also cutting other administrative costs. Digital payment options like Venmo or similar apps, those can facilitate faster payments by making it more convenient for parents to pay right on the spot. Okay. Another effective approach is to have parents pay before services are rendered. For example, requiring tuition for the coming month to be paid by the 25th of the current month. So this ensures that you have the cash in hand before you incur the expenses of providing the care. You want to have clear, consistent policies about payment timing and late fees because that'll also help establish expectations when families and um, with the families that encourages prompt payment. So just remember to enforce these policies consistently to maintain their effectiveness. Okay, the other one is reducing expenses. This is another effective way to improve your cash flow. Let's look at some specific strategies for childcare businesses. Okay, first, find the best prices for toys, materials, and equipment. Buying used toys can save you significant amounts of money. Check out your local Facebook selling groups, Goodwill, and Salvation Army. They often have toys that are available. And try visiting these stores early in the week after weekend donations. You can also use a credit card with cash back rewards for business expenses. That can provide some additional purchasing power. In addition, look for ways to discounts through large purchase programs like the one available to NAEYC members. These member benefits can often save you 10 to 20% on supplies you're already purchasing. You also want to look at reoccurring subscriptions. Okay. These can often accumulate over time. You don't realize that you're paying so much for an app or a subscription that you're not even using. Okay. You also want to review your bank and credit card statements, specifically looking for those reoccurring charges and determine which subscriptions you truly need and which you can eliminate. Okay, two more strategies to consider for improving your cash flow. First, consider your federal programs. 2 federal programs can be claimed retroactively for activities from, okay, that one is not, what I do want to mention are our 2, in Georgia, they have the 2 new tax saving credits. And we also have 2 new study groups that I do want to mention. So there's also little credits that you can do with your taxes. Again, I am not the tax expert, but they are available in the state of Georgia for you. Okay, and I think I have a slide for that. Finally, use automation to save time, which ultimately saves money. Look for ways to stretch your time and your staff's time through apps and other programs. A childcare management system can help you with billing, attendance, and other functions. You have online systems like Gusto and FreshBooks that can help you with payroll and bookkeeping. Even a free program like Google Docs can be used to collect attestations and other forms online, reducing your paperwork and administrative time. Remember, your time has value too. So every hour you spend on administrative tasks is an hour you're not spending on program quality, your parent engagement, or your personal renewal. So all of which ultimately impacts your business's success. Okay. Are there any questions? Let's open it up for some questions. Any questions to start?
I have a question. There wasn't
Yes,
no informational booklet with this class.
I'm sorry. Say that
You
again,
know,
Miss.
like the paperwork. We didn't have any paperwork we can download for this.
Oh, okay. So no handouts. However, there are some, we're going to, I think this is getting recorded and putting onto the websites. We'll have it available for recordings. And then, of course, there are resources that you can utilize, and I'm going to share that with you in just a few minutes. Okay? Any other questions? Okay.
Will this class be accredited as for that Georgia PDS?
Yes, if you please, again, remember to put your name and your PDS number into the chat so that we can get you credit for this session. Absolutely. Okay. Any other questions as we wrap up today's webinar? Okay, because I want to leave you with a few key takeaways. First, cash flow management is essential for the sustainability of your childcare business. It gives you visibility into your financial future and helps you make informed decisions. Second, regular forecasting, ideally updated weekly or at least monthly. That's going to help you anticipate those challenges before the crisis comes in. Okay. The proactive approach reduces your stress, creates more stability for your business. Third, small changes can significantly impact your financial health, whether it's speeding up collections, reducing unnecessary expenses, or increasing enrollment. These little adjustments compound over time. That creates a stronger financial foundation. And then finally, start simple and build your process over time. You don't need a complex financial system to begin forecasting cash flow. Start, first of all, with a budget. And I encourage you to take, I'll mention these here, our coaching, small steady groups. Um, Learn how to do a budget if you're not doing one, or if you have somebody that does your budget, ask those questions. That's important money and steps that you should know. And then start with the basic 5-step process that we talked about today. And then you start to refine your approach as you become more comfortable with it. Okay?